Hey, welcome everybody to the Presidio Perspective. My name is Dustin TenBroeck, and I am here with Jeff Anderson. Thank you for having us in your living room, car, wherever you're watching this today. Jeff and I have a full agenda for you. Climbing the wall of worry is, I think, where we're going to start talking about as well as giving our market outlook for 2022. And then who's going to win out, the Bulls versus the Bears, right? Lots of news going on. How you doing, Jeff?
Good. How are you?
Good. Got your Valentine's Day gift yet?
No.
Okay, little reminder out there, little public service announcement. Valentine's Day is on Monday, so get to it. Supply chain issues, we'll talk about it. Might not have the Amazon delivery in time, so you might need to brave the mall, see what's left on the shelves.
Right.
So, Jeff, let's get into it. We have yesterday, CPI, record high in over 40 years at 7.5%.
Right.
7.5% CPI. Oh my gosh, I didn't know I'd ever see it. Consumer sentiment is at the lowest it's been in over a decade.
Right.
And since 2011. And Goldman's telling us we have to prepare for essentially 7 rate hikes from the Fed. So interest rates are going to soar. Inflation is mounting. Consumer sentiment's at an all-time low. There's a lot to be worried about.
There always is, right? That wall of worry we talk about. And fear sells. So thinking about some of the things right now, let's just talk about COVID. I think that's really interesting because are we talking about in the financial news, are we talking about COVID that much anymore?
No, it seems to have disappeared from the feed, actually.
And that's all we talked about for 18 months.
That story sold, yes.
And so we're talking about inflation now. But I go back as an example, talk about COVID. January of 2020, what happened? There was this thing in Asia, this SARS. We've seen it before. We've had various bird flus, SARS viruses, and
You're saying in January of 2020?
2020.
Okay, yeah, right. I remember.
We didn't really take it seriously. And then all of a sudden, there's this thing and it's scary. And the market sold off heavily, right?
Right.
Everything ground to a halt. And that's all we really talked about for 18 months. And
it was pretty troubling, though. That was a concerning time.
Well,
right?
It's the first time I think we've ever shut down the economy,
right?
A global economy. We are truly a global economy. Everything that we buy and we own is probably sourced outside of the U.S. And it's a complicated supply chain, and so complicated that we're still having those issues. We talked about it last week. What was the number one thing companies were talking about in their earnings call? Supply chain shortages, right? Not interest rates, not employment, but supply chain. We're still having those problems. Talk about CPI. Last week or 2 weeks ago, we had our podcast. We were talking about 7%.
Yeah.
Inflation is a really high number. Now we're at 7.5. If you look at the breakdown, the big components, food, energy, cars, used cars. There's an article today in the Wall Street Journal that said if you bought a car a year and a half ago, you could sell it for more than it's worth that you paid for it.
Which is something as a financial advisor, I would have never told a client ever as a possibility.
Right.
Yeah.
If you need a car and your car is broken down, you're in a bit of a pickle.
But you're not going to sell it for more.
Right.
Okay.
And we're not getting those. We still have supply chain issues, but the supply is actually back to pre-pandemic levels. But there's this pent up demand that is still lingering. So cars, 17 million cars a year. Not all of that is people buying cars because they want. They're buying cars because they need it. And there's years in which they can't get it. You've driven by the lots going up the 5. You see these trucks and cars sitting in the lots, but they're not being sold. Why? There are no chips.
Yeah, I get my I'm one of the rare people that actually go to the dealership to get their car service. I know a lot of people say you can take a more frugal route, but one of the reasons I do that is because they always have a loaner vehicle for me.
Right.
So I went to go take mine in for service, and they said, sorry, our sales guy sold all of our loaners. They didn't have any cars to sell. They used to have a fleet of cars. Luckily, they had one left that I was able to sneak into. But yeah, it's crazy.
And they sold that probably for above sticker price.
Exactly. Yeah, because it's a used car.
Right.
So, we're not talking about COVID per se, as far as, this deadly virus that we were talking about for 18 months.
Right.
And whether you're vaccinated or not, and whether you wear a mask or not. And, I think everyone kind of just adjusted to the new normal, whatever their, path was. And that's died down, which I am one of those that's very happy to not see that in the news so much.
Right.
But we are, in a sense, still talking about COVID because all of these issues about inflation and supply chain issues are a direct result from that.
Right.
So we're still just dealing with the fallout of what measures were taken, right, to try to control that disease.
Right.
And that's why the supply chain broke down.
Right.
And okay. And so, that's interesting to hear. I did not know that we have our supply levels are back to pre-pandemic levels. That's very interesting. But demand has surged for certain items because we talked about this pig and the python before.
Right.
And we predicted it would hit in 2021. There'd be this huge surge in demand and there wouldn't be a lot of supply. And then that's the whole transitory camp. You have a pig and a python.
Right.
And you can say that supplies are back to pre-pandemic levels. But the way that a supply chain works is that it is able to meet demand in an efficient manner that keep prices somewhat stable.
Right.
Right. And so if you have a surge in demand, it's not a problem if you have a supply chain because you can produce the goods and services to get it to the consumer at the appropriate time. Right. And we as a world got very good at that over the last 20, 30 years. I mean, starting with Toyota in the 80s really perfected that. And then it's kind of permeated through this global supply chain. And so when that's disrupted, we can't turn that dial on or off, right?
Right.
So now we're having some price disparity. And you bring up used cars. You said it last episode, they were up 38% last year, which is insane. So this is a big reason why we're having the inflation, right? There's been massive stimulus, which I'm sure you're going to talk about, but the global supply chain issue is really, we aren't able to get the supply to meet the demand in an efficient manner.
And all that pent up demand too.
Well, and then so if the supply chain isn't put back together correctly, and I don't know if we have any guidance or if you have any thoughts of like how that happens or when that happens. I know there's been a big investment in our country to have more goods and services, semiconductors, whatever, clothing items produced here in America.
Right.
Right. So that's going to help, obviously. I'm not sure how much it helps on the price, but but I don't know. There could be lots of positive things that do occur from that for the country and for the American worker, especially.
Right.
But if you have this inefficient supply chain, and so, okay, well, we got to get the supply there. The other part of the supply chain being efficient is that you can dial it back.
Right.
And so is that a concern that we have? We have, okay, we got to meet this pig and the python. We oversupply. And then what happens? Is that something we're concerned about?
Well, when it comes to products, yeah, there's always a chance that that the buyers buy too much and we end up with a glut. We could be sitting here in a year from now doing our podcast for 2023. We could be talking about a glut.
Yeah.
I mean, it's possible.
Yeah.
So,
but not the concern right now.
Not the concern right now.
Okay.
I think for the first half of the year, it's still inflation. It's still the fact that we can't get the global supply chain running efficiently. And until that happens, we're probably going to have scary inflation numbers for the first half. But again, talking about that wall of worry, I mean, when I was talking about COVID was that was a 1 in 100 year pandemic, which has happened over history. But now that we're not talking about Omicron, we're talking about something different. Now, we were talking about inflation and interest rates while Omicron was still dominating the news, but we were talking about all that. But now that's kind of waned. And now the new thing is, boy, inflation's really running hot. Interest rates are going higher, and we'll talk about that a little bit later. But what does that mean for investors? And I think that there's always a wall to climb, a wall of worry. And we've talked about taking a long-term approach, but thinking about products and services, and it dovetails into this supply shortage issue. I read a stat that said that for every $8 that we have spent on stuff, the U.S. consumer, $7 has been on stuff, and $1 has been on services.
7 on product, 1 on services.
1 on services. So services being your Netflix subscription or
right. Small percentage of my household budget.
Right. Or taking a trip. Right.
Yeah.
And when you have that mismatch, when you're really overspending in one and it's stuff and the supply chain is not running efficiently, what do you have? You have supply shortages, and you're pushing up demand. It's pushing up prices, and it just becomes it's a virtuous circle that just keeps pushing things up. So
So we're spending more on products, partly because that's where the demand is, but also because that's where the surging in price is.
Right. So there's
which go hand in hand, obviously, the supply and demand work.
Right. So part of it is people like to spend, and I can't spend it on a trip, so I'm going to buy something. And on top of, there's just stuff that naturally gets replaced. Your car gets old, it breaks down, you get in an accident, something, you got to buy it. But you can't, there's just not enough for people to buy. So that pushes up prices. Like you said, you go to the
Jeff,
dealer.
How do you know there's not enough cars to buy out there? What would give you some insight in that?
The fact that I have to take a ride 3 times a week from you because I ordered a car in November and I'm not getting it till March when I was promised December.
Yeah. Can you give me the tracking number on that, by the way? I'm really curious to see when this supposed car you ordered is going to come.
So I'm curious, is the thing built and they're just waiting on chips, or is it just laying in a bunch of parts sitting on the floor? I don't know, but it's just another example. But so that wall of worry. So where are we now?
Well, so we have all this inflation you're talking about, and then you have the Fed saying, okay, we're going to take this, hawkish stance, and we are going to start increasing interest rates. We think that's obviously been priced in. And here the market is, I don't know, wouldn't say freaking out, but, to a lot of people who've just seen the market kind of go up and up and up for everything except for COVID. What does this mean? In every month of my entire career, if not week or day, somebody has asked me, is the market going to crash?
I know what your answer is.
Yeah. What's my answer?
Your answer is yes.
Yeah. Every time. Yes. I just don't know when.
And they say when. I don't know.
No, of course not.
But it will happen. And it does happen.
And it's interesting to see, I think investors really lose sight, because there's always these kinds of dialogues that we can have that are interesting and important, to have. But I think it's really important to have perspective. And here you go, a little plug for the Presidio perspective. But I really like this piece that we'll share here. So if we could put that up for those of you watching at home. Those of you who are listening, what I have is the S&P 500 over the last 40 years. And what we see in blue is where the stock market had finished for that year. And then in yellow, what were the intra-year declines? And looking back at this last 40 years, I mean, it's shocking how frequently the stock market loses 10, 12, 19, 28, 30%. Yet how often during those intra-year declines, the stock market actually finishes positive. 2009, the stock market drew down 28% before finishing 23% for the year.
Right.
The following year in 2016, it had declined 16%, did 13% that year. 2011 declined 19%, did 0% for that year. Following year, down 10%, did 13% for the year. I don't have to keep going, but I mean, it just seems like, I think the important thing for investors to know is that the stock market declines are just part of investing. And so what are we down this year? What was our low this year?
The S&P was down just a little over 9% near the end of January.
Okay, so didn't quite breach the 10, which is pretty frequent, by the way. So who knows? We could have a further decline, certainly. I think there's volatility is definitely the word we're going to use a lot this year. So I would expect a good likelihood of more volatility, and that could be to the down or to the up. But so we're down 9% this year. That's not uncommon, certainly. And that does not mean that the S&P 500 wouldn't finish positively. In fact, looking back throughout history, the odds are in our favor pretty significantly. Over the last 40 years, there's been 9 negative years, right?
So 9 of 40.
Yeah. If you actually look at the S&P going back to 1937, the stock market finished positive in a 1-year time frame, 77.23% of the time. You go out 3 years, it's 87%. You go out 5 years, it's 93%. You go out 10 years, it's 98%, right? And so time seems to be pretty important. And, the media just doesn't let us look at things like that, right? I mean, it really truncates how our window into the future, right? We're just looking at the 24-hour cycle.
Well, if we all believed in the truism of invest for the long term, the financial news media wouldn't have nothing to report about, right?
Absolutely. Right. And that doesn't get us to tune in, click, and subscribe. I have one more that I want to share here. And so this is the S&P 500 going back from 1950 to 2021. So it just shows you all of these, again, same thing, intra-year peak to trough drawdown. So how far the market drew down. This is going all the way back to 1950. And the average is about 13.6% is the average annual drawdown that the S&P 500 has done. And what's nice about this one is you look at what the stock market has actually done over that time, right? 1995, the S&P 500 is valued at less than 500, and we're sitting at almost 5,000 today.
Right.
And how many drawdowns have we had? I mean, every single year since then. There's obviously been times where the stock market's going down, but you could really miss the boat if you're too worried about intra-year declines.
Well, the most important thing is time in the market. You need to take that long-term approach to ride those out.
Yeah, I mean, and I think the point I'd like to make is that market declines don't necessarily need to translate into losses, right? Just because things are down, good investors would know that's a time to hold, if not buy more, right? It's on sale, stocks and socks, as you say.
Yeah.
Right. And so time in the market helps us buy low and sell high, right? And so just because the market's down doesn't mean that you need to lose money. And you should expect this as part of an investing cycle, that there are times when there are news events or real troubles with the economy that could have the stock market go down for a period of time. And throughout the year, that's going to be pretty common.
Well, you said something to me yesterday that I thought I'd bring up, which was, Jeff, 4 years ago, would you have said that the market's expensive?
Right.
And I would have said yes.
Yeah.
And here we are. And you would ask me the same question. Is it expensive? It's relatively expensive.
Yeah.
I mean, the S&P is trading at about 20 times forward earnings, but it's not crazy expensive. But
right.
It's been expensive for a while. But
look what you would have missed out on. Yeah,
you would have missed out on doubling your money
5 years ago. Yeah, it's been up about 93% over the last 5 years, not including dividends. So
right,
that's more than a double. And if I'm doing some quick math, so yeah, because I hear a lot of that PE ratios, CAPE ratios. I mean, it's a complicated algorithm, right? And the stock market is not dumb. It's a discounting machine, as you say, and it's taken in a lot of events. All right, well. So, okay, there's a lot to be worried about always. There's a lot to be scared about. So if we look at 2022, we're dominating the headlines with inflation and interest rates, right? So what does this mean for stocks, bonds, cash, real estate?
Well, let's just talk about interest rates very quickly. As I looked at it today, the 10-year is at 2.02%, which it's not a large number. I mean, relative to history, but where were we last year, a year ago? What was
so
the number?
You loan your money to the government. I give the government $1,000 and I get 2% to lend them my money for 10 years.
I get $20 a year.
Yeah.
And then at the end of 10 years, they're going to give me my $1,000.
Whatever the heck $1,000 is worth 10 years from now.
Right.
That's not a really bullish call on inflation over the long run.
No, it's not.
Okay.
So, that is, but it's been a pretty big move over a year. The 10-year was at 1.15.
Okay.
The 2-year is at 1.6% right now.
Wow. Yeah.
Take a guess at where it was a year ago.
I don't know. 1?
0.1.
0.1. Yes. Okay.
So has the Fed increased interest rates yet?
No. That's the
When's
market.
it supposed to happen? In March, right? Maybe it happens. Maybe there's 1 or 2 hikes in March.
Yeah. So the fixed income markets, right? They call it the canary in the coal mine.
Right.
Right. So they're going to price it in first.
They're pricing it in right now. And that's why the 2-year's gone from 0.12 to 1.6.
Okay.
That's why the 10-year's gone from 1.1 to 2.2. But what's interesting, and we've talked about it before and we've written about it, interest rates are a function of liquidity. They're a function of interest rate or inflation. They're a function of the health of the economy. And because of low interest rates, it's afforded a higher multiple for stocks, and we've had great returns over the last 5 years.
Yeah.
S&P companies are at all-time high operating margins, profit margins. I think it's 15.4%, which is the average is something like 9.
Yeah.
But these large companies, the Apples of the world, they continue to make a lot of money.
Right. The S&P 500, the highest operating margin in history. I heard that.
Right. So
that's incredible. These businesses are super strong and they're making a ton of dough.
Right. So cheap money allows you to borrow money, invest at very low rates, and get high returns.
But I mean, corporate balance sheets aren't, from what I understand, over levered or just built up with debt. I mean, these companies are having really profitable businesses and funding a lot of their R&D and acquisitions through cash flows.
They're sitting on a lot of cash.
Yeah.
And what are they?
And lots of cash on the balance sheet. Yeah, good point.
Right. And so just like us, they're not earning anything.
right?
I think you talked about one company yesterday that had great earnings, and they're going to put how many billions into R&D?
Oh yeah. I forget the statistic, but
it was, I mean, they have the same problem that we have. It's like, we've got this cash, it's not earning anything. What are we going to do with it? Well, it's a great time if you have a good business model to reinvest at high returns. If you're generating 50% operating profits, you got that cost, you continue to invest, and what happens? You become even more competitive. You become even more.
They increased R&D by 150%, right? With having,
it's a staggering number.
Yeah, exactly.
And didn't do it with debt.
Right.
They weren't forced to do it
with cash flow.
Right. Business is going well, and they're plowing back to keep their competitive advantage. Right.
Yeah. So biotech, technology companies investing for the future which really bodes well for the growth and if you believe we're in this exponential growth phase with technology and biogenomics, AI, robotics, et cetera, and these companies being able to invest in the future, not through debt, but through cash flows, is pretty positive.
And that's a healthy way to run your business.
And I mean, we're going to really lose sight of that if we just talk about how many rate hikes are going to be.
Right.
Right. Because that's a short-term temporary problem. I think about, in my early career, which was, when I started in the business, which was much, much after when you started in the business. But when I started, you were a veteran by that time, but I like to jab you on that one.
I know you do.
But yeah, so a lot of my clients had invested in the 70s and 80s, who were retiring at that time. And, they look back at the 80s and they go, oh yeah, we had record inflation. My interest rates on my mortgage were 10, 11, 12, 13, 14%.
Right.
I say, how'd you do? I'm like, I did pretty well. I did really well. My income was growing massively every year. My real estate holdings were like doubling in value every 3 or 4 years. So, it's interesting when we think about this generation of investor or advisor, we haven't lived through higher interest rates, higher inflation. We haven't been through that world. I mean, me as a homeowner, I have never seen my home go down in value. I mean, that's where I've entered. I know you have a different story, Jeff, but I was just fortunate and lucky of when I was born and when I was buying my first house, right. And it was just after 2008. So I've never seen and how many people are in my boat, right, that are out there. So, we're going to have some learnings there, but we have to draw back. We've seen this before, and it hasn't been all doom and gloom.
No, it hasn't. And we have, like you said, we've persevered in many environments.
All right. So bond market, interest rates are up. So, when we look at duration, these are bonds that are more sensitive to rises in interest rates. Now, it's good that we do have, this really helps, I think, when we think of asset allocation, right? If you do have some yield in your bond portfolios, there's some room, right, in a market decline for there to be some demand, right? And you can get that buoy again.
Right.
I'm interested to see what happens on that longer duration, longer term bonds that they haven't moved like the shorter term is kind of concerning to me, right? And so I think we would probably suggest to investors to make sure you understand how long dated your maturities are.
Right.
Because if I could loan to the government for 2 years and make 1.57, or loan for them for 10 years and make 2, I don't know. For me, I'm going to do 1.57.
Right.
And so what has to happen? Well, there's less demand for the 10-year notes, which means that prices come down, which means that yields go up, right? And so that's something that will probably, wouldn't be too hard to see if the short-term end of the curve holds up like this.
Right.
Okay. So interest rates going up will hurt those long duration bonds.
Right.
Let's kind of come down to, cash. We don't need to talk about that. You lost 7.5% over last year.
Yep.
Okay, so you lost 7.5%, worse than what the S&P 500 has done year to date, right? So that's been your decline in cash.
Right.
Okay, so
not to mention the gains in the S&P the year before.
Right. Over the last year, it's positive, 13, 14%, I think. Real estate. Okay, so real estate, what I was kind of just talking about, has been just going up, right, for the last 12, 13 years. And we know there's market cycles and we know it's coming. How much higher can home prices go? We've just had 2 record years. Now we have interest rates starting to climb. Are we about to kind of tip over the edge there?
Well, that's a good point. For the first, I don't know how long it took, maybe 7 or 8 years to get back to annual housing starts, production of homes We built too many coming into the GFC to the crisis, and then we didn't build enough.
Yep.
And the economy or the population's still growing. There are people, household formations, people coming out of college, getting jobs, needing houses. There weren't enough houses. And then interest rates started going lower. So interest rates go lower, it makes house prices more affordable, but then it pushes up house prices. You don't have enough supply for the homes, or not enough supply out there, so it pushes prices higher because there's more people competing to buy less homes. And then COVID happens, and then there's no homes being built.
Well, here in a lot of the markets here in San Diego, Orange County, these are expensive markets, right? Just California in general. So it's not a lot of first-time home buyers, out there making their first acquisition that's really driving the median home price here, right? I mean, it's a lot of trading up the equity or trading down, or
well, that, and there's just not enough supply. Everybody says everybody's leaving California. Well, I wouldn't say that that's the case.
Well, yeah, we did have a population decline for the first time. We did. We had people leaving California. I just wonder who was leaving.
Yeah, well, that was kind of more COVID related, right? But over the last 10 years, I think it's still been a net inflow of people.
Sure.
So where house prices are sensitive to interest rates, when interest rates go lower, if you can only afford, say your monthly budget is $4,000 in mortgage, interest rates go lower, you can afford a higher priced house. Same thing on the other end. If interest rates start to go up, you're still assuming your wages don't really go up that much. You can still only afford the $4,000. Prices have to come down. So that's logically what would happen, right? So we'll see where we are in a year from now, but supply has to catch up. If supply is low, people are going to dig a little bit deeper, and they're going to try their best to purchase a home. But there is a limit to it based on interest rates. Everything we're talking about is really dependent on interest rates. Like I said, we haven't had any hikes in interest rates.
Which is dependent on inflation.
Which is dependent on inflation. So the Fed is really worried about inflation for the first time in 40 years.
Right.
And so they're going to hike rates until they get inflation under control, and then they'll stop.
So we have all this news, and I just, when I look at these asset classes, cash is, kind of a non-factor. And so they call fixed income the canary in the coal mine, right? So for your kind of big events, you're watching what fixed income is doing, the value of the dollar, right?
Right.
So I guess you put that with cash, the value of the dollar, maybe is first indicator. What the fixed income market's doing. The stock market is, our crystal ball. They're a discounting machine looking 6, 9, 12 months into the future and pricing all of that into what's going on in the market today. Then you have the economy. Okay. So you have all of that. Then what actually happens in the economy, and then you have real estate. Right. It's a lagging indicator. It's always after the fact. It doesn't lead into it. Right. People are going to be reactionary. And so, the economy and the stock market, if you look at 2000, going back to the great financial crisis, we sell off. 2009, stock market starts buoying up, right? The economy's not back together, but it sees it. Then the economy starts coming back together, 10, 11, 12. Real estate doesn't hit its bottom until 2011 in the best markets, 2015, 16 in other markets, right? This big lagging indicator. So I think that's important to note too when we're making decisions about our asset classes. I'm talking about residential homes, obviously.
Well, that's house prices. Another interesting part about housing is the actual home builders.
Yeah.
And the home building sector is actually down, I think, 16% this year. You know why?
Why?
Interest rates.
Right.
Interest rates go higher. It makes housing more expensive, and then it slows down demand. And that will be something interesting to watch. I think the studies it takes about 75 basis points of hikes to really put a dent in demand.
So we have inflation. Relative to the rest of the world, how's our inflation numbers compared to what's going on globally?
We're higher than almost everybody.
So the dollar's weakening.
Slightly. Right.
Which bodes well for investments internationally, specifically emerging markets.
Right. And they typically have a negative relationship.
So now we're tightening monetary policy, and which would say we're strengthening the dollar. But how's our monetary policy tightening going compared to international markets?
Well, I just looked that up.
Yeah.
I thought that was interesting because what was your preconceived notion about it? Nobody's raising.
I thought we were leading the hawkish stance from
it's not true. We are getting more hawkish globally. And until and because of that, the dollar probably has an upper limit to it. It's not going to continue to go higher with interest rates going higher because you have other countries doing the same thing. So something to watch.
something to watch. And when we look at all of these things, emerging markets, US stocks, small cap, large cap, let's pull up this chart here. And I'd like to just go over this with you. And so if we could get that up. Interesting. So let's take a look at this chart here. And, this is, again, just the importance of asset allocation, right? And you kind of don't want all of your eggs in one basket. I think most investors have heard that and know that. And many of them that did that last year, right? They got the meme stocks and the coins and the, whatever high flying growth tech, and they put it all in, they put in what's winning, and now they're losing big. Of course, they just say, hey, I'm in it for the long term, right? It's like, it's how we have such an ability as human beings to just escape any responsibility of our failures. It's phenomenal. But that ego will come in and save you just in the nick of time. But hey, it's not an ego game. It's important. It's just math. We want to make sure that we have a good asset allocation in our portfolio. We're not always chasing winners, So I like this chart. I call it the periodic table of investment returns. And I kind of just a research company, the Callan Institute, updates this, puts it out every year. Been doing it forever, my whole career. And the colors are all you need to know. You just look at the colors, right? There's orange, blue, gray, yellow, light blue, dark blue, greens, etc. And all of those represent a different asset class. And at first, I don't want anybody to read any of these asset classes. Just, do you see a solid color on top as the best performer for that year? Do you see a solid color at the bottom? No, we do not. So there's not a winner every time that just wins every year. In fact, a lot of times the biggest winners, the more frequent winners, seem to be the most frequent losers. Right? If we take in the points, emerging markets, right, have finished first place, right, more than anybody else. They finished last place, right, aside from cash, more than anything else. And their dives can be deeper, right? Well, we know that emerging markets are a riskier asset class.
Right.
And what do we know about investors as far as modern portfolio theory is concerned is the more risk you take, the more potential you have for reward. So what is that? And so I think investors, one, need to make sure they understand what their risk tolerances are. Are you prepared to ride this ride? And if you are, know that what risk means is that you can be investing in the S&P 500 and have your investments underperform, right? Or you could be investing in stocks, rather, have the S&P 500 do well and have your investments not perform, right? If you were all in small cap, right, in 2020, you outperformed, you did great. You underperformed in 2021 and so far year to date, which is, again, a riskier asset class. So, we can look at some of this stuff on the margin, right? And where in fixed income do we want to be? How much cash to have in a portfolio, et cetera? What's your tilt, international versus domestic, maybe large, mid, and small. But the importance is not to throw the baby out with the bathwater. You don't go all in. You don't go all out. That's not what a good portfolio does. Right. And you have to make sure you have the right asset allocation to ride out these storms.
And another interesting point about that, it's not in there, is think about those returns. Investors rarely get those returns because they might be in the right asset class, but they're trying to time the market.
Oh, and I mean, I know everybody listening has done this at some point, right? They opened it, maybe hopefully it was early on in their investing career, but so many people do this. They tell me this all the time in my courses and in my consultations. When I ask, how do you manage your 401k? They say, I don't do anything. I'm like, oh, you've probably done very well then, But if they say, what I do is I look at the funds that I'm in and I look at what's doing well, and then I'll put more money into that one. I'll look at what's not doing well and I'll take money out of there. It's like, well, you like to buy high and sell low, which is what most of us like to do, that genetic defect in our financial DNA. Right. So, conversely, sometimes our biggest losers become our winners. But that's not necessarily true. You can't just go buy your losers every time. Just because it's down doesn't mean it's going to go up.
Right.
So we have to have a different kind of approach to investing. So here we go. We got the bulls versus the bears. Who's going to win out? I mean, over a long enough time horizon, there's only bulls. Right?
Right.
I mean, there's no bear markets for that 15-year period.
Right.
And looking at that statistic I quoted before, over 10-year period since 1937, we made money almost 98% of the time. Right. So obviously the bears are short term, but they're always out there. They're always out there calling for the market to crash.
And they're out there lurking, trying to scare you out of your.
Well, they're gold salesmen for sure, right? Annuity salesmen, gold salesmen, right? Buy cash value life insurance, whatever it might be. But or bond investors, bond salesmen, right? Bill Gross, the old bond king. You know, the famous line about him, right? Famous for calling 10 of the last 2 recessions.
Right.
I love that line. It's so great.
That is one of my favorite.
And the news media is going to sell the bear case too, because that's what we're looking at.
They're always bearish.
And so we are bombarded by bears when the market is usually, call it a bull. Over. If you look at bear markets, they're pretty short-lived, right?
Right.
I mean, you look at 2000 to 2003 or 2008 to 2009. You know, you can go back in 1987 when the market crashed 34%. Oh my gosh, it finished positive for the year. You know, and so we always have these bear cases. And so, what should we listen to?
Your financial advisor.
Oh, that's a good segue. That's nice. That's a nice plug there. But I mean,
you need a plan.
You showed me this, so I'll let you talk us through this. But I thought this was pretty interesting when I looked at, what is this? The climbing the wall of worry over the last, since 2008?
Since 2008. So that chart will pop up, and it was provided by First Trust. I thought it was great because you look at the dark blue. This
is what, the S&P 500?
This is the S&P 500 from just
2007.
2007, just before the market corrected with the housing crash.
Okay, through 2020.
Through 2020.
So if you you know what this is? This is the height of the S&P before it started going down. I've looked at this a lot of times. So they took the height. They took out the S&P at its high in 2007. And they said, had you invested in the very worst time, right?
Mm-hmm.
This is you investing in the worst time you could have bought the S&P 500 and holding through the end of 2020, which is 12 and a half years.
Right.
You averaged 9.78%, going through like the great financial crisis, the worst stock market crash since the Great Depression. And we finished
in the first year and a half, you'd have lost 50% of your money, unrealized. But
your money would have declined.
Well, a lot of people
wouldn't have lost.
A lot of people panicked, but yeah, you're absolutely right.
Well, and then so what we have here are all the reasons why people have panicked since that period of time. And oh my gosh, Jeff, I remember them as I read them, but I forget about all of this worry. But there was just the Brexit vote, end of QE. That was in there a lot of times, right? We have Russia moves troops into Crimea. Seems like it's the same kind of altered story over time. And look at what the stock market has done.
We say those things now and there's no emotional connection to any of them. But at the time, there was a large emotional connection to them. This is it. Plus, we were coming off a correction in 2008 that we hadn't seen in decades. And people were looking for any excuse, any bad news to get out of their portfolios.
So what should we take from this?
There's always going to be bad news. We talked about it. It was COVID for 18 months. Now it's inflation, interest rates. And a year from now, it may be supply gluts.
Yeah.
There's always something to worry about.
Yeah, some of these are a little bit more concerning than I think what we're looking at today. They put Donald Trump was elected as the president as one of the events.
He was supposed to be bad for the stock market.
Well, yeah, I don't know. I remember that day very specifically. I had 2 clients call me the week of the election, both saying to go all to cash. One asked why. One said, because I think Trump's going to win. And the other one said, I think Hillary's going to win. God. 2 opposing views and the same action is the stock market's going to crash. So
right.
I think what I get from this is, there's always something to be afraid of, but how resilient this stock market is over time. And yes, there are periods of time where the accounts look pretty pitiful during some period of time here. So that's not to understate that the stock market just goes up in perpetuity, because it clearly doesn't when we look at this. And looking at those intra-year declines, investors need to be prepared when investing to see their stock accounts go down. And it's pretty impossible to just decide when that's going to happen, because I look at all of these events and some of them caused some reaction, some of them didn't. Yeah. And we had some ending of QE multiple times through this period of time. Doesn't seem like it was too permanent, but
the U.S. was downgraded from its AAA status.
That's when I remember. That's when I remember pretty significantly. That's when the everything was going to go down. When was that? 2010, 11?
Oh, when was the S&P downgraded? I can't see it with this one.
Yeah, I don't know. I have too small of a one, but I remember that was signaling the end. But we've gone up. I don't know. 200% since then. All right. So let's give some takeaways for the show. So, I mean, I think some takeaways are there's always bad news out there. Okay. So there's always something to be afraid of. What's our best solution for that? Is time.
Right.
Right. And so that's what we say. The number one most important criteria to invest in is time and knowing your time horizon. So I think for investors today, especially new investors, to understand what is your time horizon in this investment. When you say, oh, now I'm long-term, what is that long-term? And what allows you to be long-term? Well, that I have a financial plan where I know that I'm going to be able to meet my expenses through cash flows or through other safe investments like fixed income, cash, et cetera. Right.
Right.
And so, some investors are saying, oh, I'm just long-term. And, what if you lose your job one day? Maybe you can't be long-term. Right. So do you have the emergencies? Do you have the contingency plans for changes in your financial future that are still going to allow you to hold in a bad market?
You also need to know what kind of investor you are.
Yeah.
We've had a raging bull market for 5 years, with the exception of COVID, but that was short-lived. A lot of people say they can take volatility until it happens. That's when they're really tested.
That's true.
Your portfolio needs to match your makeup, your risk tolerance.
So is your asset allocation matching your plan? Do you have enough safe investments in there to weather the storm and to take out the volatility of your portfolio so you don't freak out and panic? Right? That's important. And then rebalancing. That's something that I think a lot of people haven't done and are just learning about, but rebalancing their portfolios at the proper points, because you might get it set up correctly, but then, now the stock market's grown, fixed income is not, you have overweights to equities, and now we go through a recession or a bad market, and you're going to exacerbate the losses that you said you were comfortable with if you're not rebalancing.
Exactly.
And it's important to do that at a scheduled time. Right. Not just like target date retirement funds or something that systematically sell stocks and buy bonds every year. Right. We want something a little bit different than that.
Right.
And I guess the ultimate goal to remember is to buy low and sell high.
That's the key. That's the name of the game.
That's what we're trying to do. So, well, Jeff, thank you for bringing some insight and perspective to all of these events. I have no idea what we're going to be talking about 2 weeks from now, but it's really interesting when we do the prep for the show that we have had to seemingly schedule it for the morning of. We try to get together during the week. We meet on Tuesdays. We talk about what we're going to talk about this week, and so often, it comes to Friday, and we got to throw out the agenda. Like, well, that's not even news anymore. Right. So who knows? Stay tuned. We'll bring you our perspective here at the Presidio Perspective. I'm Dustin TenBroeck here with Jeff Anderson, and we'll see you in a couple weeks. Thanks, guys. Have a great weekend.
Bye-bye.